So in the last class, we started a discussion on cost of capital, And in that class, we said cost of capital is regarded as opportunity costs of finance because it is the minimum return that investors require on their investments. Otherwise, they will transfer some or all their investments to another place or company. And if the return is higher than the opportunity cost of capital, more investors will be attracted to the stock, or the current stock owners will be pleased and will buy more stock. So what we're saying is that if the cost of capital, if the return is higher than the cost of capital, people will want to invest more. If you are buying shares for 1 naira per share and you are getting a return of 5 naira, it means people will be encouraged to buy more. So if the opportunity cost, if the return is higher than the opportunity cost is the sacrifice you're making, the price you are paying. But if the return is higher than the opportunity cost, you will be more pushed to buy more stock, more to invest more in an organization. So the cost of capital is the minimum required rate of return on investment projects that leaves wealth of shareholders unchanged. So in that class, we talked about cost of equity majorly, yes, and we looked at various examples, and we looked at how growth rates can be measured, yes, using dividend historical approach and the Gordon's growth model. In that class, we said cost of capital can be measured using dividend valuation model or CAPM. CAPM is capital asset pricing model. Though in that class, we didn't dwell much on CAPM. We dwell more on how dividend can grow when we have constant dividend and we have growing dividend. So that forms the discussion in the last class. So examples are assignments were given. Quite a number of persons have solved the assignments and have seen them. One major error some persons made is in one of the assignments, it was stated that dividend is yet to be paid, but maybe an oversight, they didn't less the dividend, the unpaid dividend from the quoted price, from the market value. They use the market value directly. So you must be very careful when the question is saying dividend is unpaid, is yet to be paid, will be paid. You need to less that dividend that is yet to be paid from the market price for you to have it as XD. Because when the dividend is yet to be paid, the price is still quoted at COMDIV. So once the dividend is paid, the price is what is quoted as what XD, as XD. And one more observation is if you are using your values in units, you have to be consistent in using it in units, and you must be very careful. One of the question was saying gives the dividend for each year in kobo. 30 kobo. 30 kobo means the return for one share will be 30 kobo. 30 kobo cannot be the overall share for that year. It's not possible. So the examiner will not tell you that 30 kobo, because in the example we solved in class, one of the examples we solved in class, where is it? Dividend was quoted in Yeah, something like this. This dividend now, I should know that this dividend is for the whole year or for the whole shares, because 180,000 can be dividend for the whole shares in a year. But when it is 1 naira, 30 kobo, I should know that it is just for one share. Yes, these are some of the um, observations we have to take note when solving questions. When solving questions. But on a general note, it was a good one. A good one. So, in brief, before I move to the next form of cost of capital, which will be cost of preference shares, let's quickly talk about CAPM. Though CAPM, I will just talk about it in brief. It's a concept that you keep using as you keep solving questions on financial management. So when we talk about CAPM, we are simply referring to capital asset pricing model. Capital asset pricing model. Capital asset pricing model. Capital asset pricing model is CAPM. Now, this is also a way in which you can determine what cost of equity. The first approach is dividend valuation model, but under dividend valuation model, we have various subheadings under it, where we have a constant dividend, where dividend is growing, and we have various formulas to showcase that. So another approach to determine cost of equity, because when you get to weighted average cost of capital, and you are trying to use project specific cost of capital to solve project specific cost of capital, the steps you have to follow will require you to determine cost of equity. And that step will require you to use the application of CAPM to determine cost of equity. So when we get to that point, this will not be strange again to us, because you know that another way to determine cost of equity aside dividend valuation model is capital asset pricing model, which is CAPM. Now the question is, what is this capital asset pricing model? Now, this capital asset pricing model, it's cut across different topics. When you're talking about portfolio theory, likewise, you'll be seeing issues of CAPM coming up likewise. Because in portfolio theory, it involves you diversifying your assets to mitigate risk. So, capital asset pricing model, this is the minimum required rate of return. I don't have the notes here, but let me just write it. That when you talk about capital asset pricing model, this is the minimum required rate of return. Minimum required rate of return for a risky asset.
Good evening, sir. Sorry, I can't see your screen again.
Okay, is it the only one that can't see my screen?
It's network.
I can see it, so
Network.
it's network.
Can
Log
see
out
your
and
screen.
log in again.
So capital
Okay,
asset
thank you.
pricing model. This is the minimum required rate of return for a risky asset. For a risky asset. Now, why is CAPM being discussed in this regard? You know, I said when you talk about portfolio theory, CAPM will also resurface. In portfolio theory, we are looking at trying to see how we can diversify our risk among our investments. If this project is risky, we should invest in another one that is less riskier, so that when there is much pressure on the risky project, there will be less pressure on the less risky project. In that case, we can absorb the risk, and the risk will not overweigh the business because your investments have been diversified. So why CAPM? The question is why CAPM? Capital asset pricing model is useful because it explicitly accounts for an investment riskiness. It accounts for an investment riskiness, and it can be applied by any company, regardless of its dividend size, regardless of its dividend growth, and so on and so forth. So this method, tagged CAPM, capital asset pricing model, it relies heavily on past performance to predict the future. So you look at your trend, your past results, to be able to draw an informed decision that will impact on the future. So that is what CAPM does. It relies on past data to predict the future. So capital asset pricing model states that the expected return on equity, that is, the expected return on equity is the sum of the risk-free rate of interest. In simple terms, what CAPM is talking about is this risk or return on equity represented as this. Like you can represent it as RE, yes, whichever. But what it's saying is that so what CAPM is simply saying is that your expected minimum return or minimum required rate of return should be equal to your risk-free, which is represented as RF, your risk-free rate of return represented as RF plus what? Plus your beta factor. Beta factor. When we talk about beta, what do we refer to? Beta. Beta. What do we refer to? This is not your first time of doing FM. Most of us, I don't think this is our first time. So from what you've read in the past, what is CAPM? What is beta? Yes, we have various forms of beta. We have asset beta, we have equity beta, and the rest of it. So what is beta? Let me see, what are the people on this call? Madam Victoria John, permit me to call you.
Good evening, sir.
Good evening, ma. Let me hear your voice. I know you want to be very quiet, but I will not allow you.
Mr. I can't remember anymore. I just need refreshment now.
I am following my hand.
Oh,
You can't remember.
I can even trying to, but
Okay, it's fine, it's fine. Yes, we are humans. It's I want to yes. Right. So when we talk about beta, beta is a measure of security systematic risk. Yes. So beta shows how sensitive a share return is to movement in the market return. So if you look at the formula, you see that beta is associated with the market premium. So what beta does is that in a security market, most especially when you are talking about portfolio theory, there's what we call security market line. So in a security market, the security moves in line with the market. So beta is a determinant. As the beta variable changes, the condition of the market changes. So beta tells us how risky a share is compared to the market and how much return investors will demand for that risk. So beta, in simple terms, is a measure of risk. Is a measure of risk. So if you want to now go further, you now start talking about systematic risk, unsystematic risk, talking about diversifiable risk, undiversifiable risk, and the rest of it. So, but in simple terms, beta is a measure of risk. So, Kaplan formula is what? RF plus what? Plus your beta. Plus your beta. Where is my beta? RF plus beta into the bracket of what? RM
minus RF.
RM minus what? RF.
RF.
So what is the interpretation of all this so that you not say what is this story that he's writing? The definition of all this is RS is equal to what? Expected what? Minimum required rate of return. Depends. It can also be your cost of equity, yes, because the cost of equity in this regard, what the company is paying back to the investor is a cost to them, yes. So the expected minimum required rate of return, what the investors are expecting to get in return, is a cost to the organization, but to the investor is a return. Please know how to interpret it very well. Yes, so expected
Hello, can anyone hear me?
Yes, yes.
Okay.
Yes.
That's my
Okay.
network.
Okay. I think Mr. Tokwe is off.
Yes, sorry about that. I received a call that I don't want to reject. So that is why I just have to pick the call. Yes. Hope you can hear me, please.
Yes, I can hear you.
All right. Yes. So RS is expected minimum required rate of return. And what is RF? RF is equal to what? Risk-free. Risk-free rate of return. Risk-free rate of return. And we have our beta to be what? Is beta factor. Beta factor for the company's equity share. And also, we have what? We have RM. And the RM is equal to what?
Market
Return,
premium.
return of the market. Return of the market. But in some cases, some questions will not give you these various variables. They can just give you in a statement, they can just say the market risk premium is this. What is market risk premium? Market risk premium is RM minus RF. Take note. You must know all this so that when you start seeing question, you won't say, but they didn't give us risk free. Like if you go to the pilot question, I think there is a question like that. Yes. So RM minus RF most times in a question will be summarized, will be solved for you. And this is same thing as what? Equity risk premium. Equity risk premium. Or take note of these various names. The examiner can use any name. Or market risk premium. Market risk premium. Market risk premium. Please take note of this. Now, question on CAPM, they are not something complex, but by the time we move ahead to portfolio theory, to specific project cost of capital, we are going to see how to use this formula. We're going to see how to use this formula. So, for the subject matter of today's class, I want us to look at cost of preference share. Cost of preference share. The question I'll ask is, what is preference share? What is preference share? Yeah, what is preference share? You know, if I should reflect back, since those of you that did commerce, you'll be hearing of preference share. Yes, yes.
Can I try it?
Yes, you can try.
Is the share capital that attracts a fixed rate of return.
Yes, that is it. The share, it attracts fixed rates of return. Yes, but let me now take it further. What is the difference between preference share and ordinary share? You should know, those days we used to draw table in our commerce class.
The difference is that preference share
Yes.
has a fixed rate of return, whereas ordinary share does not.
Yes.
Then another difference is that in case of liquidation of a company, preference shareholders will be paid first before the ordinary shareholders.
Okay. Yes. More. At least you'll be able to tell me 5. 2.
Yay!
Yeah. Somebody else can assist.
Ordinary shareholders are the owners of the.
Have a preferential treatment.
Okay. Adam Agbola, can you speak?
Ordinary shareholders, they are the real owners of the business.
Okay. Yes, Faith.
Okay. Preference shareholders, they have a preferential treatment in the sense that if there is any case of insolvency in the business, they will first of all be attended to before. I mean, they will give them their return first before any the ordinary shareholders.
All right.
Preferred shareholders have no voting rights like the ordinary shareholders.
Yes, yes, that is also part of it. Yes. All right. So thank you very much, everybody. So preference shares, also known as preferred stock, is also known as what? Preferred stock, are shares of a company's stock with dividends that are paid out to shareholders before ordinary share dividends are issued. So in the event of liquidation, the shareholders with preference share are settled from the company's assets before the ordinary shareholders. So most preference shares have a fixed dividend. They have a fixed dividend. And also, just as one of us have mentioned, preference shareholders do not have any voting rights in the company. So preference share combines futures of debt and equity because it pays fixed dividend and has the potential to appreciate in price. So preference share could be cumulative or non-cumulative. Preference shares could be what? Participating or non-participating. Preference share could be what? Redeemable or irredeemable. I don't know if you recall some of these things over time. Now, as a matter of fact, we have two forms of preference shares that we'll talk about in this class. Yes, in last diet class, I didn't talk about preference share intensively. Well, I would like to talk about it now because it will reduce the work for me when I'm trying to talk about issues of debt, issue of debt. Yes. So it will reduce the stress there. I might not even need to talk much about it because everything we'll talk here in preference share will still reciprocate in the issue of cost of debt. So I would like to dwell more on preference share. Now, we'll be looking at two forms of preference shares: cost of irredeemable preference shares and cost of redeemable preference shares. Costs of irredeemable preference shares and cost of redeemable preference shares. We'll be looking at them. Yes. So when we talk about cost of irredeemable preference share, this is a situation where the company will pay fixed dividend to perpetuity. That is till infinity. That is without end. So, and the principal will not be repaid. This is irredeemable. But for redeemable, what will happen? At the end of the period that has been stated in the question that this debenture will be redeemable at the end of 2 years, what will happen? Both the interest and the nominal value will be repaid, will be recouped back for redeemable. But for irredeemable, we don't do that. So the cost of preference share is the yield on preference shares. So the shares may be issued at par, at premium, or at a discount. Now, when we say shares are issued at par, at premium, or at discount, what are we referring to? Can I get reactions? Some of you work with
100%.
that is at par, right?
Yes.
Come again with
Yes.
the question, sir, please.
That's
Hello, sir.
when we
Is
say
this the right
shares,
of word?
when we say shares are issued at par, at premium, or at discount, what are we referring to?
Yes, we are
Hello,
referring
sir. Can you
to.
hear me?
Yes, I can hear you. Okay.
Hello, sir.
Yes, I can hear you.
When it is issued at par, it means that it is issued at the market rate, at the market price. Then premium is more than the market price, and discount is less than the market price.
All right. That is it. So when shares are issued at par, when shares are issued at par, it means the shares are issued at their nominal value or face value. Yes, at their nominal value or face value. And when shares are issued at premium, it means the shares are issued above their nominal value, above par. If the share is quoted at 10 at nominal and it's now issued at 110, that 10 extra is what is the premium. And if it is issued at discount, it means shares are issued below the nominal value. It means share of 100 now being issued at 80 naira. It shows that it is being issued at discount. So cost of irredeemable preference shares can be calculated as what? Can be calculated as seen on the screen. Yes. Or let me write it in another way. Please take note as you go through various textbook, you will see different ways in which they put these formulas down. Just take note that they are same thing. Just stick to one and hold for to it. So for irredeemable preference share, we can compute it as what? As dividend divided by what? By the SDIV preference share price. SDIV preference share price. Another word for the share price is market value. Take note, market value. Market value. So this is the formula to compute irredeemable. Please note it, irredeemable preference share. Very straightforward. You can write in this way if you want. That is dividend divided by market value. Market value multiplied by 100, still same thing with what is above, multiplied by 100. So you can have it this way. So this KP is cost of irredeemable preference shares. And the D is what? Is the dividend. And the market value, MVP, is the XDIV. Take note, XDIV. You don't just see the price of the share and put it like that. If the question is telling you that dividend is yet to be paid, you remove that value that is yet to be paid from the quoted market price for you to have it in form of what? XDIV. For you to have it in form of XDIV. Let's take this example. I don't know if the example is here. Okay, all right. Let's take this example to buttress this discussion. I have two tutorials on my class now. So, example, Victoria PLC. Victoria PLC has an issue preference shares, preference share with the nominal value of 25 kobo. 25 kobo. The agreed dividend of 5 kobo has just been paid. has just been paid. Required. What is the cost of preference share? Of preference share. So this is an example for irredeemable. Irredeemable. And please take note. A question can ask you to calculate redeemable preference share, but you need to read the question to know if it is actually redeemable. Once there is no specific timeline for the principal, for the capital to be repaid back, to be recouped back, no, you are calculating irredeemable. Take note of that. Once there is no statement telling you that the redemption time or the redemption year is in 5 years' time, know that you are computing what? You are computing irredeemable. Because I have a question like that. The question just made it look as if you are to compute redeemable, but in the real sense, it is not redeemable. It is irredeemable. So now, for this question now, what are we going to do? Calculation of cost of preference share. What are we going to do?
%.
Hello, sir, I can see you.
All right. Is she the only one that can say that?
It's your network. It's your network.
So, okay, let me go back. Maybe she can see it now. Can you see it now?
Okay, it's fine. It's fine. It has come. It has come. Yes, sir. Absolutely.
So calculation of cost of preference share. So the formula, based on the formula we have here, based on the formula we have here, what are you going to do?
Dividend over market value times 100%. 5 kobo over 25 kobo.
Okay. Question again. Sorry, let me locate my question. Right, calculation of cost of preference share. So from the formula, it is what? Your dividend.
5 kobo. 5
Okay,
kobo
5 kobo
by 25 kobo.
and 25 kobo multiple. And that
The answer is
20%.
The answer is 2 kobo.
okay. So from the question, your dividend is what?
5 kobo.
5 kobo.
0.05. And the price, nominal value,
It's 25 kobo.
Okay.
so when you do this simplification, you now have it at
20%.
20%.
20%. So this is for irredeemable. For irredeemable. Please take note. This is for irredeemable. There are other examples in the lecture slide but I think this one is a very straightforward something for irredeemable. Now, the major point is the case of redeemable, yes, redeemable. So for redeemable preference shares, what are we going to look out for? Redeemable preference shares. Yes, you want to say something?
For redeemable, we look at for the number of years that the capital is going to be paid.
Okay. So for redeemable preference shares, these are shares that are repaid after a specific period of time. So where preference shares are redeemable, the company will pay a fixed dividend and a final repayment of the principal at maturity. So the cost of redeemable preference share, for you to calculate the cost of redeemable preference share, you must calculate your present value. You must know what your present value is, just like the way we compute for debt. So we'll look for our internal rate of return. So I'm trying to say all these at this point. So when we get to the other points, I will not need to talk too much. So we need to use our internal rate of return, IRR formula, to determine our cost of redeemable preference shares. So what are the things that you need to do? You need to get two discount factor. Yes. To determine two discount factor. One will give you a positive NPV and one will give you a negative NPV. That is for redeemable. So at the final year, you repay back the principal and the interest. So for redeemable preference share, you need to determine the amount of fixed dividend payments per annum. And sometimes you can determine this by multiplying the coupon rate with the nominal share and find the present value, usually from year 1 to the year of redemption. Now, the year of redemption is the year you're going to buy back everything, collect back everything. So once the year of redemption is stated in the question, know you are computing redeemable preference shares. So once you do that, you present your information in a table by calculating the present value of the variables of your interest. Then at the last year, what you do, you add your principal and your interest. But in most times, you might not do it that way. You can just have your interest in a single line and have your redemption value in the last line. So we're going to see that scenario now. I believe we still recall our internal rate of return formula.
Yes, sir.
Yes.
I have it here. Yes, can you see my screen? So this is in a way, this is internal rate of return formula that you have it as lower discount factor. In some book, they can represent this lower discount factor as A. It's just for you to know what A connotes, the interpretation of A, plus positive NPV. In some books, they can represent positive NPV to be NPV of A. Divide by what? NPV of A, or positive NPV minus Take note, minus against minus. This is a negative NPV. So the negative NPV multiplied by this minus, we change to what? We change to plus. So in most book, they'll directly write plus here. But for you to know the basis of the plus, you must know that the minus at this point is multiplying this negative sign of the negative NPV to change to plus. So that you not just go and use plus without knowing the basis. So in your own word, let me rewrite this formula in another way. So we can have it cost of preference share, redeemable preference share can be equal to A plus NPV of A, NPV of A divide by NPV of A plus NPV of B. Let me write out everything first. Then into the bracket of, I'll still put the necessary division sign. So this one, we have a division sign here to be this. This, I can represent this, I can put this in subscript. In subscript, yes. So this likewise, I have it in subscript. So all this value here, you treat this one first. Please take note, the bracket is covering everything. You treat these items in bracket first. If you are writing it in your book, yes, you treat these items in brackets. And take note, any result you have, you are multiplying it by what? By B minus A. B minus A. This is just another way to write what is above. So A is the lower discount factor. And NPV of A is a positive NPV. And NPV of A minus NPV of B. That minus will change to what? Plus. When you treat this one, the rule of BODMAS, everything in brackets will be treated first, followed by what? Multiplication. So the higher the which is this. So now, let's look at an example. Let's look at an example. Example. Let's see. Things here. Example. Yes, any question?
Sir, please, I've not finished copying the formula that you wrote. My network logged me out, so I just came back. Thank you. Let me copy first. Thank you, sir.
So we have this example that Fate PLC. Fate PLC is financed with 1 million redeemable 1 million redeemable preference shares. 1 million redeemable preference shares with a nominal value. With a nominal value of what? Of 1 naira. Of 1 naira. And the nominal rate. And the nominal rate of 8%. A nominal rate of 8%. But currently quoted at what? At 1 naira and 5 kobo. XD. The preference share will be redeemable or will be redeemed at par in 5 years' time. In 5 years' time. Required. Calculates the cost of preference share. Calculate the cost of preference share. Yes, as I was writing this, a question popped up in my mind, and I would like to ask. Now, when we talk about, though I've asked, yes, I've asked, but still, what is the difference between nominal value and nominal rate? Nominal value and nominal rate. What is the difference?
So let me try. The nominal value is the total amount of shares, whereas the rate is the cost of the capital.
Okay.
I think the nominal value is the face value of the investment.
Okay.
Why the nominal rate is the percentage rate of the investment cost. That's my own understanding. Thank you.
Okay. Yes, I want us to understand these concepts. It's very important, so that a point will come when we start dividing the overall nominal value to get certain things. You won't get confused. Yes, just as you said, yes, you are correct. The nominal value, otherwise known as par value, is the face value of the preference share stated in the share certificate, while the nominal rate of preference share is the fixed percentage rate at which dividend is paid on the nominal value. For example, if you want to know the dividend for these 1 million redeemable preference share, how will you know the dividend? What is the dividend?
The rate.
How will you get the dividend? The dividend, yes. What is the dividend for 1 million redeemable preference shares?
Is 8% of the 1 million. 1 million naira.
Good. Very good. 8% of 1 million naira. That is the dividend you should expect. Yes. So because if you have 1 million redeemable preference share and it is quoted at a nominal rate of 8%, what is your expectation in return? It should be 8% of 1 million. So that will be your dividend. That will be your dividend in return. So now, for us to solve this question, which is a redeemable preference share question, what are we going to do? What are we going to do? First, for us to calculate the cost of redeemable preference share, we're going to assume two discount factor or two discount rates. Some literatures call it trial and error approach. But the point is this: once you use the first discount factor, once you assume the first discount factor, and you have, let's say you use 5%, and you have a positive PV, NPV, for you to get a negative NPV, what will you do? What will you do? We use 5% as our discount factor, and we are having a positive NPV. For us to get a negative NPV, what are we going to do?
We use higher rate.
We use higher rates. Yes, we use higher rates. So once we get these values, positive and negative, we are now going to substitute into what? The internal rate of return formula. The internal rate of return formula. Yes?
So what I want to ask is this: in the assumption of rates for the calculation of IRR,
Yes,
internal accounting rate of return. No, okay, internal rate of return. Sorry. Now,
yes,
what if maybe you try the first rate and maybe you are getting negative, MPV? What
yes,
will
sir.
you do at that point in time? Maybe in
You
a exam setting.
You reduce the, if you use, let's say you use 20% and you arrive at a negative NPV, sir.
Yes.
Just bring it down to 10.
Okay. Okay.
You have a positive NPV that you
Yes,
can
sir.
work with.
Yeah, thank you very much.
Yes, sir. So now we're going to assume two discount factor. Solution. This is it. Solution. That is calculation of costs of redeemable preference shares. Redeemable preference share. So what are we going to do? We'll assume two discount factor. Well, I'll solve the discount factor separately, but if you want, you can solve, I think in this, if you look at these, my workings here, for another question, you can see I solve them on the same sheet. Okay, I think I can still go that way likewise. I can still do that. So we'll assume two discount factor. I'll assume 5%. Let's see what the results will give us. Assume 5%. Now, from this question, how many years are we looking at?
5 years.
5 years. In year zero, what happens in year zero? In year zero, what happens?
There is no
bring the
return,
number.
sir.
Initial capital.
Yes,
Initial
the
cost.
year zero is the year that you
The
invest.
investment was made.
Yes, and that is why it is called year zero. Year zero. So take note. I believe you have your calculator so that when you are doing yes, there's something still I need to show us. Let me go back there. You want to use solve for annuity. Where is it? Let me show us the formula. Instead of doing your discount factor one after the other, you can just use yes, this approach. You see it. For example, you want to get a discount factor from year 1 to 5. Instead of doing it one after the other, you can just use this annuity formula. Do you see it? To get your discount factor from year 1 to 5. From year 1 to 5. But you can still do it year 1, year 2, year 3, year 4. But one thing with the exams, you must devise a way to beat the time. Yes, sometimes I might be writing a course. It's not because I don't know it. It's because I didn't manage my time very well. You understand? So you must devise a way to manage your time very fast in the hall. Yes. So instead of doing it year 1, year 2, year 3, year 4, year 5, use your annuity formula and get.
Can you zoom the screen again? Can you zoom it out, please?
Can you see it now?
It's still not clear enough.
It's still not clear?
Yeah, I want to see, is it that it says 1 minus bracket open 1 plus raised to power of what? Is it
minus n? Minus
okay.
n.
Okay, fine. Thank you, sir.
So as I was saying, you must, as you practice, you must practice how to be very fast likewise in using your time. Yes, in using your time. Before you go to the hall, you arrange yourself how you want to answer your questions. So now we have our years. The year. We can have details or items depending on how you want to. We can have cash flow. Cash flow. We can have a discount factor. Discount factor at what? At 5%. At 5%. Then we have our present value. So now, as at year 0, we said year 0. Fine, let me go back to the question. So this year 0, that Faith PLC is financed with 1 million redeemable preference share with a nominal value of 1 naira and a nominal rate of 8%, but currently quoted at 1 naira and 5 kobo SD. The preference share will be redeemed at par in 5 years' time required. Okay. Now, what is the market value of these 1 million shares? Current market value of these 1 million shares.
1 naira.
1 naira is the point.
1 naira 5 kobo.
1 naira 50.
Yes, 1 naira 50 kobo is the value of 1, right?
Yes.
So of the
Yes,
1
yes.
of the 1 million of the 1 million shares.
So your question again, sir.
Now, if 1 naira and 5 kobo is the current value of 1 preference shares, what is the overall value of 1 million shares?
1,050,000.
50,000. Yes.
Yes,
1
1
million
million and 50,000. Let me write it out. Let me do the workings. Very important. Let me show the workings. Let me just write it. Let me take my time. Workings. Workings. Number 1, current value. Current value of the share. This is calculated by multiplying the XDiv share price with the number of preference share number of preference share. That is the nominal share now. So the current value will be equal to what? 1 million multiplied by what? 1.05 to be equal to what? 1,050,000. 1,050,000. Now, since the dividend is what? We have to pay a dividend at the rate of what? 8%. What will happen? Still, let's show that workings. We have a fixed dividend. Fixed dividend. Since it is clearly put 8%, fixed dividend, we'll have it as what? This is calculated. This is calculated by multiplying the nominal rates with the nominal rate with nominal share. It's nominal share. So we now have it as what? Fixed dividend. Fixed dividend will be equal to what? 1 million multiplied by what? 8%. Now your dividend will now be what? For each year?
80,000.
80,000.
80,000 naira. 80,000 naira. So now, at redemption, what will happen? Let's show that workings too. At redemption, what will happen? At redemption, at the date of redemption, redemption value, what will happen? At redemption, what will happen? The par value of preference share in the question is what? What is the par value?
Naira.
Preference.
100.
So, as at the day of redemption, what will be the redemption value?
1 naira 5 kobo.
No, it will be the nominal value. You understand? Multiplied by the number of what? By the number of shares. You are redeeming back your capital. Do you get?
Yes, yes, sir.
You are redeeming back your capital as at the redemption date. You understand? As at the redemption date. So calculation of cost of preference shares. If that is not stated as 1 naira, you know, we usually use 100 when it comes to loan. Loan, bond, their nominal value is, where it is not stated, it is assumed to be what? 100 or 1,000. So we get to see that. So redemption value, let me write that since the preference share will be redeemed at par. Will be redeemed at par. See, therefore, the redemption value redemption value will be calculated by multiplying the nominal value. The nominal value its number of preference share. Number of what? Preference share. So we have it as what? Redemption value will be equal to what? 1 million multiplied by what? By 1. So you have it as what? 1 million naira. 1 million naira. So as at the last day, it will be your dividend plus what? Plus your redemption value. So now let's come back to this our table. As at year 0, the current market value is what? Current market value is what?
That should be 1,050,000.
1,050,000. The discount factor in year 0 is what? It's always what? 1. Now, why is it always 1? You should be able to explain that to somebody, not say that is how it is. So why is it always 1?
Because the value is multiplied by 0.
Because it's the year of investment. That's the year we make the investment.
Okay. Okay. Because that is year we make them. I don't understand this topic. Please, can you speak out and tell us what you don't understand about the topic?
So I went for physical class, so I joined half, and I do not I've been following, but I so don't understand it.
Okay, that means you joined late, right?
Yes.
That is the reason.
Okay. Don't worry, you understand.
Okay.
Yes.
Now let me try.
Okay, you still want to talk about why is it 1 in year 0?
I want to try. Maybe I can get it. I think it is because the power is raised by 0. The power
Okay.
is 0. That means if you are using indices, when the power is raised by 0, it will now be equal to.
Okay. All right. So this is the reason. This is the reason. Year 0 is today. You understand, man? Year 0 is now. So the interpretation is money received today does not need to be discounted because there is no waiting time. So what 1 naira can do now, it is what it can do now. Let me speak that English. There is no any other drama to it. So, but what 1 naira can do now, it might not be able to do it tomorrow. So that is why you need a discount factor after year 0. So 1 naira today is what 1 naira today, not more and not less. And that is why it is always what? 1. So a cash flow occurring at year 0 is already in present value terms. It is as at today's time. You understand? And that is why the PV will always be multiplied by 1 to give you same result. So multiplying 1,050,000 by 1 makes the results to be same. So there is no change in it because the value of 1,050,000 naira as at year 0 is still that same value. Hope this is clear, please.
Yes, sir.
So that you not just say, now so that they do. Yes. So it's a concept that you keep seeing over and over again. Yes, as you practice this profession. So for year 0, 1 multiplied by 1,050,000 will give you what? Your present value will be what?
1,050,000.
1,050,000.
So because for year 1 now, since you've invested your money, your expected return is your dividend. Your dividend, is it an inflow or outflow?
Inflow.
Inflow. So we're going to look for the discount factor of our inflow from year 1 to 5. I will not do it year 1, year 2, year 3. We'll just do it. We'll do a cumulative effect of it. Year 1 to 5. We have our dividend. What is our dividend? Our inflow. The dividend is what? For each year is what?
80,000 naira.
80,000 naira. So what is the discount factor for year 1 to 5? Using what? Using 5%. The discount factor
4.329.
4.329.
4.33. Okay.
4.33. Okay, let's use 3 decimal place. 4.329. Who is not getting 4.329? We need to teach how to press calculator. If you are not getting it, just voice out, please. Esther.
Sir?
Have you gotten 4.329?
No.
Hello.
What is
Okay.
the real difference?
I need the calculator punching. Madam Rose. Okay. This is the formula we are applying. See this formula here. Because we are doing year 1 to 5, we are using the annuity factor. So from your calculator or in your book, write it down first. This is 1 minus what? Open brackets, 1 plus. The I is 5%. That is 1 plus 0.05. Write it. 0.05 to the power of what? Minus 5. Divide by what? 0.05. So once you simplify, your result will be what? Once you simplify, your result will be what? Your result will be what? Simplify this. So you should have 4.329. 4.329. So, Madam Rose, you are there. Who is not there again?
Yes, sir.
Okay, you are there, ma. Fine.
I have gotten it.
Okay. Madam Esther.
So I've gotten it.
Okay, good. Yes, Mr. Gabriel.
Yes, please show us how you arrive at that 3.7 now we're calculating.
Can you people just please be in parlor, please?
So to get 3.79 or 4.329, right? Sorry, these figures you are seeing, they are not our workings. I'm just using these the formula here. You get?
Yes.
Yes. I'm just using the formula. Okay, let me go back and copy it. This is where we are. You understand? So this is our worksheet. So we're trying to get the discount factor for year 1 to 5. So what are we going to do? We use this annuity formula. Once you break it down, you punch your calculator, your result should be what? 4 point what? 329. So your 4.329 is your discount factor for year 1 to what? Year 1 to 5.
5.
So what would be your present value?
346, 320.
346, 320. Take notes. These are just your dividend. As at year 5, as at year 5 again, we should have our redemption value. Year 5. Your redemption value will be what?
£1,000,000.
Yes, redemption value is 1 million naira. We've shown that in our workings, 1 million naira. So what is the present value for just year 5? How will you get that? The present value for year 5.
0.784.
Okay, 0.784. How did you punch that now, your calculator?
1.05 minus 5. Principal minus 5.
That is 1 plus r to the power of what?
5 minus 5.
To the power of minus 5. So if you are computing for just year 1, you put 1 in place of 5. For year 2, you put 2 in place of 5. That is how to compute. If you want to do this process year by year, but instead of doing it year by year, you can just use this formula. But since we are only trying to get the redemption value for the 5th year, we just say 1 plus r. What is r? R is your 5%. And it is the same thing as what? 0.05. So 1 plus 0.05 is 1.05 to the power of minus 5. Once you punch that on your calculator, you are going to have what? 0.7 what? 84. So your present value will now be what? When you multiply 1 million by 0.784, it should be 784,000.
784,000.
So your PV, your MPV will now be what? MPV,
MPV is
you add
positive 8320.
$11.30.
MPV, you add these two together, they are positive, and you minus this value, 1,050,000.
80,320.
Is it negative?
Positive.
Yes, sir.
So
It's positive. Positive.
positive.
It's positive.
So since this is positive, what are we going to do to get a negative MPV?
Let's use 30%.
30 is too much now. 15%.
10 up.
Let's use 10%.
Up.
I don't want to go far too much.
10%.
Let's try 10%. Take note, when you are doing it in the hall and you didn't get positive or negative immediately, don't panic. It is called try and error method. Quickly draw another table and use a higher value. You understand? And try to see how you can get a negative value. So don't begin to trouble yourself too much. That is why it is called trial and error approach. So, but at least as you are doing trial and error approach, you can try to be perfect a little so that the trial will not be too much. So let's try discount factor at 10%. At 10%. The PV. I'm using the same table. So the discount factor here will still be, as year 0 will still be 1, and the value will still be what? 1,050,000. And 50,000. So what would be the annuity factor for year 1 to 5 at 10%? Now this will be this formula here will be 0.1. 10% is 0.1 to the power of -5. This one too will change to 0.1. So once you simplify, what will be your results? 3.791. So we have it as 3.791. Who is not getting 3.791? Madam Victoria, Oni, are you getting 3.791?
Yes, sir.
All right, ma'am. 3.791. Esther, are you getting 3.791?
Yes, sir.
Madam Chikodili, are you getting 3.791?
I've not pressed it, but I know the formula.
Okay. When will you press it?
So I'm a bit busy. Oh,
Go. Okay. All right. So 3.791 multiplied by 346,320. We're going to have what? Okay. Sorry, multiplied by 80,000. Sorry. 3.791 multiplied by 80,000. We're going to have what?
303,280.
303,280. Now, for our redemption value, what will be the present value? The discount factor at 10% for just only year 5.
0.621.
So we have it as 0.621. 0.621. 0.621. So when you multiply by 1 million, the present value will be what?
621,000.
621,000. So when you do plus and minus, 303,280 plus 621,000 minus 1 million and
125,720.
negative 125,720. Is this clear, please? Is this clear?
Yes, sir.
So please, hope you have this right up in your book, everybody.
Yes,
Do
sir.
you have it in your book?
Yes,
Please
sir.
write
We're
it in
still
your book.
writing.
I'm going to the, we're going to apply the internal rate of return formula now. So I'm going to where the formula is. You will now place each of the value where you ought to place it in the formula. Yes. So if you've not been writing, please quickly write this down. If not, to look as if
Please, sir. I don't know this contract. So have you tried it yourself? Because I'm not getting 3.791. I've tried it so many times. I'm getting 6.145. I don't know if it's. I don't know.
okay, ma. Let's do it together.
Yeah.
Let's do it together, ma. On your calculator.
Yes, sir.
Press 1.1.
Okay, I'm with you.
To the power of -5.
Is it -5 or -10? Yeah, is it 10% now?
No, 10% is the 0.1 in the brackets. The number of year is still 5.
Oh, okay. Thank you. Okay.
Thank you for speaking out. So in case you are still in such dilemma, you can speak out likewise.
Yes, I've gotten it. Thank you. Yeah, thank you.
So everybody write these out, because I'm not going to. This class is you have to write. So it's not a class you come and look at what the tutor is doing. It's a participatory class. So now, having derived these values, we move to what? To substitute into our internal rate of return formula to get the costs of preference share. To get the cost of preference share. So let's go there now. Change my slide. The internal rate of return formula. Do you have it in your book?
Yes, sir.
We put it down the other time. Yes. Yes, I think this is not the one I put down anyway. But that is also the formula. I'm looking for that actual one. Let me change. Okay. I didn't see it. Let me adopt another one. So the internal rate of return formula, we have it as this. Let me still adopt this. Let me adopt this. Now, from what we've solved, our A is what?
5%.
So why is it 5%?
It has positive
The
NPV.
lower rate.
Lowest discount
Because
rate.
it's the lower rate.
Between 5 and 10, which one is lower?
5.
So it is 5. So A is what? 5. Plus, please be writing it. Be writing it in your book. Be writing it. 5 plus, then MPV of A. What is MPV of A?
80,300.
20.
MPV of A.
I got 320.
See the definition. MPV of A. MPV that gives what?
Positive.
Positive MPV. Using the lowest rate. So which MPV is giving you a positive value? That is the MPV of A. What is MPV of A from your calculation?
80,320.
80,320.
Write it. Write it. MPV of A 80,320. Write it in the formula. Substitute that into this portion here. So now you come down to the denominator. MPV of A, still you repeat what? 8320, isn't it? 8320. Now there is a minus here. This minus is constant. Yes. So the MPV of B, you know, is a negative figure. Is a negative figure, right? So that negative value multiplied by negative make you have what?
Positive.
So it will now be what? 8320 plus what?
125,720.
125,720. You are done with this aspect. Multiply by what is B?
10%.
Fine, 10%. Minus A. A is what?
5%. 5%.
So write all those things into the formula and press your calculator. Give us the final answer.
%6.9%.
6.9%. That is very good. 6.9%. Who is also getting 6.9%?
I never get to.
Yes, sir. 6.9%.
6.1.
Please get it. I'm waiting. So, do you have that result now?
So I didn't get it though.
You didn't get it. Can you call your figures? What did you have in your book? Tell me how are you pressing your calculator? Let's start from there. You do the one in bracket first. You understand?
The one up.
You do the one in brackets. So now, this is how you do it. 8320 plus 125,720. What do you have?
Okay. 8320
Plus 125,720.
6.949.
Eh?
60206.
040.
Yes.
6.95.
I made a mistake. I didn't calculate the upper NPV again. When I got that. Oh.
So the issue is from you, right?
Yes, sir. Thank you, sir.
Okay, fine. So who else is yet to get 6.949, approximately 7%? With
6.95.
okay, fine. So that is the cost of preference share.
6.95.
Very good.
Thank you, sir.
So that is the cost of preference share. So where the preference share is what is redeemable, that is how to solve. But where it is what irredeemable, you just apply that as simple formula and you move on. So now we're going to look at cost of debt. Cost of debt capital. Cost of debt capital. It's not far-fetched from what we've done. Yes, but let's look at it. Cost of debt capital. Now, to you, what is cost of debt? The cost of borrowing money. What is the cost? Can we share idea? What is the cost? When you borrow money, when you borrow someone money, what is the cost?
The cost is the interest you pay.
The interest you pay on it.
The interest you pay. Now, in terms of debt, debt is a cheap source of finance. Debt is a cheap source of finance. Why is it cheap?
It is cheap because in calculation of tax, I think it is being exempted.
Very good.
I think yes, it's cheap because you don't pay tax.
Yes. So debt enjoys a tax shield, tax savings, because interest on debt is tax deductible. While returns on equity, cost of equity, does not enjoy that. So that is why I say it's a cheap source of finance. So the interest on debt is treated as an expense in business, as an expense. So it's enjoying tax shield. So why have I come this way? So when you're trying to solve for cost of irredeemable debt, the formula is, as you've seen on the screen, the interest. It is your interest net tax. How do you net tax? It is 1 minus the tax rate given in the question. So the interest into the bracket of 1 minus t divided by what? Market value of debt, x interest, excluding what? Interest. Just as we have x div. In the case of debt, it is what? Excluding interest. So when we talk about cost of debt, this is the compensation required by the providers of debt capital from their investments in the company. So it is the effective rate a company pays on its current debt finance. So cost of debt is a cheaper source of finance to a company because it is tax deductible. So it's a benefit to the business. So debt may be redeemable or irredeemable. In another way, you can say callable or non-callable. So irredeemable debt, as you can see on the screen, is a kind of debt which is not required to be repaid during the lifetime of the company. You don't need to repay it during the lifetime of it. That is why we have irredeemable and redeemable. Redeemable is the opposite of irredeemable. So this means that the company will pay only the annual fixed interest to perpetuity, but the principal will not be repaid. So such debt carries a coupon rate of interest. So this coupon rate of interest represents the before tax cost of debt. So after tax cost of perpetual debt can be calculated by adjusting the corporate tax before the tax cost of capital. As you can see in the formula, that is interest is equal to, into the bracket, 1 minus T. 1 minus T all over market value of debt, or X interest. X interest is interest. So why cost of redeemable debt? Cost of redeemable debt. This is a kind of debt in which the company will pay annual fixed interest and the principal at maturity. It means at the day of redemption, the principal will be paid back, just as we've looked at the preference share. Same approach. So the redeemable debt is a debt that the issuer may buy back from the company. Yes, if I give you debt, I can decide to buy it back, or the bond may be called at the discretion of the issuer. So these are certain issues that has to do with debt. You know, we have various form of debt. We have various forms of debt. We have traded debt and non-traded debt. So when we talk about non-traded debt, or traded debt rather, let me talk about that first. Traded debt. Traded debt are mainly fixed income securities that can be bought or sold between two parties. And what they do is that they have basic terms. There is a definition of basic terms regarding traded debt, such as notional amount, that is amount borrowed, the interest rates, the maturity, and the renewable date. Examples of traded debt: we can look at debentures. We can look at bonds, that is corporate or government bonds. We can look at loan notes. These are traded debts, while the non-traded debts are securities that are not usually traded or tradable in organized and other financial markets, which means they cannot be bought or sold in the market. Who can give me an example of such non-traded debts? Example. That you cannot go to a market and say you want to buy it. You want to get it. Yes.
Overdraft.
Very good. Overdraft. Overdraft. Even bank loan. You cannot go to Nigerian Stock Exchange market and say, I want to get bank loan. What you get there are bonds, debentures, loan notes, and the rest.
Commercial paper
So
also.
Sir?
Commercial paper.
Yes. So all these. So please take note. Debt is always quoted at what? 100 naira per unit. That is the nominal value. Take note of that, please. So in some questions, by the time we are redeeming, as at the end of the period, it will always be 100 plus the interest. 100 plus the, except otherwise stated in the question. Yes. The examiner will not even tell you. So you are supposed to know that debt nominal value is what? 100 naira per unit. 100 naira per unit. Don't expect the examiner to tell you. Expect you to know. So don't begin to look for it in a question. Except they have keen interest in that particular variable as far as the question is concerned. So, but where it is not stated and you are solving a question that involves redeemable debt, just know that as at the last day or the maturity date, you have to redeem back at 100 naira per unit. So it means if you have 1 million ordinary and 1 million debt, 1 million multiplied by 100. That is if you want to work in total. But if you want to work based on units, you just pick your 100 and the interest, you add together, and you solve. And you solve. So let's so please take note, this is the formula for irredeemable. Why for redeemable?
Please, please, I want to ask a question again on this, on the debt you just mentioned now. You said that debt is always quoted at nominal value of 100 naira per unit.
Yes, sir.
I think you said plus something. I just tried to get that. I can't get that at all.
Okay. Plus, as at the end, as at the maturity date, let's go back to the preference shares that we saw. As at the maturity date, you are expected to add your nominal value and your interest.
Okay.
Yes, if you look at the example we saw, the dividend, we computed year 1 to 5. Do you get that? You observe that, sir?
Yes, sir. Yes.
So you can solve it in another way. Instead of including year 5 dividend in that row, you can just add it to the redemption value and get your results. You still get same results. Do you understand, sir?
Yes, I
You understand? Because if you go to some other literatures, they might do it one after the other. So as at year 5, you add your redemption value and your interest or dividend, as the case may be. So
it's clear. Thank you very much.
So to solve for debts irredeemable, you use this formula. Write it in your book. Use this formula. So we have this question, though it's solved already, that a company has an issue 5% irredeemable loan notes. 5% irredeemable loan notes, currently quoted at what? 105.5 cum interest. What is the interpretation of this cum interest? Somebody should speak to this.
There is interest. Interest is added
Have
in.
not been paid.
Yes,
Yes.
has not been paid.
So how are you going to solve it?
You remove
We
the
remove the
interest.
interest.
You deduct interest.
So you can see it here. You need the value of X interest. So you say 105 minus the interest. What is the interest rate? The interest is what? The interest is what?
5%.
5%. So the interest is 5%. So 5% of 100 is what? 100 naira is what?
5 naira.
5 naira. That is how we derive 5 here. You understand? So 105 here quoted, but cum interest. To get it as interest, you remove the interest that is there to be paid. 105.5 minus 5, you have what? 100.5. 100.5. So now, based on the formula we've shown earlier on, interest into the bracket of what? 1 minus t, market value of this. Now, in the question that assume a corporation tax of what? 30%. 30%. Calculate the cost of the debenture. So now, your interest is what? Your interest is what? 5. Isn't it? 5. Based on tax, net tax, it will be what? 1 minus 30%, that is 0.3. All over the market value of debt, excluding interest, you have what? 100.5. Multiply by 100%. What will you have?
3.48%.
Okay, approximately 3.5. Approximately 3.5. Approximately 3.5. So take down this question and solve. Give me the answer.
Please, before that question, please.
Yes.
I want to know how we got that 105.5 from that S interest.
This is it, sir. Quoted.
Okay. It's clear. Sorry. Thank you very much.
Mr. Michael, are you the one that just asked question?
Yes, sir.
Okay.
Yes, sir.
I'm looking for a name to use. So any name that have been.
You are permitted.
Lisa, let me see the question again.
Are we for Jared now?
Yes, sir.
Anchor PLC is financed with 10 million. 10 million, 9% redeemable. Yes, that is where the confusion will come. Let me see something. Redeemable debenture. Redeemable debenture. Quoted at 102 naira. Interest in debenture was paid last week. What is the cost of debenture? What is the cost of debenture? If the company is not liable to pay tax. If the company is not liable to pay tax. And 2, where the company tax rates is 40%. So what are we going to do? Somebody should help me. So what are we going to do now? What do you understand by this question? Yes. Somebody should speak. It's very straightforward, right? Yes, let's talk.
If you ask me, I think I can understand from that question is that Michael PLC is financed with 10 million naira financed with 10 million naira redeemable debenture at 9% interest rate, yes. And then the market rate and the market value or the nominal value is 102 naira. Okay, so that's what I can get so far. And they say that the company is not liable to pay tax.
Yes, that is the first scenario. The first scenario, you have to solve based on the fact that the company is not liable to pay tax. So what are we going to do? My question is, let's say redeemable. But when something is redeemable, they should tell us when it will be redeemed, isn't it?
But this one is not showing.
It's not showing. So what is this question? This is irredeemable. You know, I've explained this before. I talked about this before. That when they are putting, but they didn't tell you the time frame you are solving for what?
That is wickedness, oh.
It's not wickedness, it's understanding.
Because
it's not wickedness now.
But that redeemable that is there is confusing now.
You say you should interpret.
Ha. Allah.
And that is why you're in this class, to know that when you are reading questions, you must be very careful, yes, of what to do part time. And so this is just an eye opener, you understand? So it's just for you to apply the formula we have. You understand? Let me write out this. Don't let me bore you too much. Solution. Say it's wickedness. It's not wickedness now. That's what everybody used to say.
I can't.
It's not wickedness.
I can't.
It's not wickedness. So when you give somebody assignment in your office and the person is not paying attention to detail and the person bring stupid report to you, will you be happy?
I will cancel the report. You go and do it again.
Yeah, that is what this exam is teaching you, that you must learn to pay attention to details. Yes, that is what it's teaching you. Not just you say you collect the quality, you are now misbehaving. No, it's part of this thing. If I want to do anything now, if I'm doing anything, I'm always very careful. You understand? If not, you see somebody will tell you, especially in your office, some people can beef you very well. Once you say you are chattered, and you say you are chattered. You understand? So you have to be very careful once you are presenting certain things. So that is one thing the exams have will teach you, that you look at information very well. You don't just sign documents likewise, because you have people waiting to criticize you very well. They are there waiting in your office,
especially Anam people.
I beg you.
So that thing happened to somebody in my office last year. So there's this assignment that was given to her, but because the time was too short, so the internal auditor just asked her to sign that the thing should just go, and she carelessly signed it. So she did not think that the thing is going to go to the head office. By the time she was informed on Monday that the thing has gone to the head office, she said, that she did not check the job, because the auditor said she should sign it. She just signed it. In fact, see the way she was crying. A chartered accountant, she was crying.
Those are some of those things now. It's one thing to have the certificate. Then after having the certificate, it's another work on its own. Yes. So you have to sustain that name. So there are certain things. I don't involve myself in my office. They should be doing it. Yes, I don't care. Yes, so they should be doing it. My name should not. I don't care. So they should be doing what they are doing. I'm doing my own. So that is how it works. So, because when some people come from Abuja now, at least it should be. So that is how it works. So the point is, they want you to pay attention to details, because there are many critics out there waiting for you. Yes, once you say you are chattered now, so people are not happy. They're just looking for how to. Even as you are writing these exams, some of them are not happy.
Yes.
So once you write and you didn't get it, they'll come and ask you how far. So once you tell them, I remain one. Okay. So now, based on this question, it's a very straightforward question. In the first instance, they said the company is not liable to pay tax, right? So what is your interest? What is your interest?
9%.
9%.
9%. Your interest is 9%. 9%. 9%. How do you get 9%? The par value of a debt is what? 100. 9% of 100 is what? Is 9. So your interest is 9, right? This is without tax. Without tax. Divide by what?
So you will show the workings of that par value and chemical.
Interest.
And when we are ready, we'll be able to remember.
Interest is equal to what? 100 multiplied by 9% into 0.09 equal to what? 9. So your interest is 9. Divide by what? S interest is what? The debenture is currently quoted at what?
102.
102. Multiply by what? 100. So the result is what? Will give you what?
%8.8.
8.8%. Approximately your cost of debt will be equal to what?
9%.
9%. So now, if the company will pay tax, what will be the difference? You should be able to solve this very
Yes,
fast.
ma'am. Let's try it. %5.3%.
Okay, 5.3%. Fine. Fine. Who else is getting that?
5.3.
5.3. So what is the difference between the difference is just that you put what here? You less 1 minus 4%, 0.4. 1 minus 0.4, that is 40%. So once you do that, you should have 5.3%, approximately 5%. Is that clear, please?
Yes, sir.
So I will give 2 assignments now. One will be on redeemable debenture. You follow the procedure of redeemable preference shares. One will be on irredeemable debenture. So next class when we meet, we conclude cost of capital. The next part is not that much, is the aspect of WACC, where we look for the average of cost of equity, cost of preference share, cost of debt. So that is called weighted average cost of capital. Weighted average cost of capital, that is WACC. So we'll now bring question that will marry everything together. That will marry cost of equity, cost of preference share, cost of debt. That will marry everything. Then you now look for the WACC, the average, the proportion of equity in the overall organization capital structure, the proportion of preference share in the overall capital structure, the proportion of debt in the overall capital structure of the organization. So in the next class, we're going to conclude this. Then you can refer to the question pack. You see questions on each of these. Then you can solve further. So, but now let's take down these questions as assignments. As assignments. Let's take these questions as assignments to further to understanding.
Hello, sir.
Yes, I'm with you, sir.
Yeah, please. I would like you to help us. Whenever an assignment is given and we all attempt, try to give our own understanding to the question by that
Yes.
is looking at the solution that we have given out. I think there is also
Yes.
need for you to kind of maybe just give either a 5 minutes just to recap and then possibly show the correct answer to the question that we're given as an assignment, so that some of us that either make mistake or actually or either get it right or something, we also know that that what we have done is the correct thing or what we have done is wrong. So we're able to take correction from there, please. I would like you to help
Yes.
that on a general note, please.
And that aspect is being done at the back end. Yes. Once did you attempt the last assignment, sir?
Yes, I did, but I didn't get the reply you gave to
My
me
feedback.
was clear.
You didn't get my feedback.
Yes, I got your feedback, but it wasn't clear enough. I didn't get there, so I was hoping that in our class today that you were able to give an explanation on it, maybe just throw more light on it.
Okay. Though I have my reasons for not discussing assignments in class.
Okay, maybe
So,
I will call you later in the day. Maybe I'll send the chat
yes.
later in the day. Thank you, sir.
Yes, because one thing I prefer to discuss once I give assignments and you've solved and I said correct, fine. What I did last diet is that I will still solve it and send my correct solution to the platform where people are not clear they are.
Okay.
But this diet, I discover we are just starting, and I discover people were able to solve that last assignment very well based on their understanding. So that is why. Now, the essence of the class is once I come to class, because we don't have time.
Yeah.
If I should review some of those assignments again, we might still be on those assignments now.
Okay.
So that is why I'm doing the assignments at the back end. So if you have any issue, any gray area, just call me.
Okay.
Yes. If I'm not free at that time, I'll tell you. Then I'll schedule a time that me and you will discuss the question. Yes.
It's okay. Thank you.
Yes. So
thank you.
Yes. So we just have to balance it up. Yes. And I
Hello,
also
sir.
know that.
Okay. Continue.
And I also know that some of the assignments might be coming in a rush. I understand. Yes. But for these exams, it's better you sacrifice and face it. Don't need to complain about too much assignments. You sacrifice and face it and allow this phase to go. Finish ICANN and forget about it.
Yes.
Yes. So if you have any question about any assignment, you can reach out to me. I think Madam Macaulay was trying to call me the other time. I was in an environment that was very noisy. So she said she's going to call me back like that. Though
So
I've not
it is the same question I've asked you before. But when I went back to check, I saw how you calculated. It was on the machine hour issue, so I've gotten it.
Okay, all right. Thank you very much, ma'am.
Please, sir, my question is that this video, is there anyhow you can be sending to us so that we can go back, because we have a lot of things on our platform. It will get to a time that maybe you are working on it and you need a video to clarify some things. You will not be able to get it on time.
Ma'am,
Sir.
let me give you this advice. Once I send a video to the platform, the recorded link to the platform, quickly send it to your personal WhatsApp page. Do you get that?
Okay, sir.
Quickly, you can send message to yourself on WhatsApp, right?
Yes.
Yes, quickly send it to yourself. So anytime you want to access it, you just quickly go to your personal WhatsApp page and get it. Because actually, we have many informations on the platform. People are submitting assignments, the videos.
Thank you, sir.
So just quickly do that. Like me now, most of my information, I usually forward it to myself. So as I'm looking for it, I just go to my personal page, get it. So that is how it works now.
Thank you.
So take down these assignments. I have to go. No. Assignments. Madam Oni, you raise up your hand. Sorry, I don't know if you still want to say something.
Yes, sir. Well done, sir.
Right.
The second assignment, I didn't attempt it. The cost of capital.
Okay, ma'am.
So I was a bit confused because I saw market value and I saw capital employed. So I don't know whether I should multiply the market value by the capital employed, or I should use the market value only, or I use the capital employed only. So I was just learning about the assignment.
Yes, that's the question. Yes, you referred to. Actually, it's you can use two approach to tackle that question. But based on what we've discussed in class and we emphasize, you don't need to bore yourself with the issue of capital employed. It's when you want to go through the Gordon's growth model, then you now use the capital employed variables to solve that question. To solve that question. What is the question?
The question seems the formula the question seems Gordon growth model, but it was really extrapolation model because we were given the latest dividend, and there's another dividend that was given in the question. And now the question has a market value of 3 naira and something, if I would remember, and you still have a capital employed. So to me, the question was somehow confusing. So because if I to be Gordon growth model, I will now have to use the capital employed for the retention, or what is it? But it was extrapolation method because we were given two dividend in the question, which has one is latest and the one was paid 5 years ago. That is base dividend.
All right, sorry, I have to. Okay, fine. I have to mute you because once your mic is on, I'll get my voice. I'll keep hearing my voice again. So let me talk. Let me speak to that question. That question, you can solve it in two ways. You can determine your growth rate in two ways, which most people use the first approach, using the square root approach. Yes, don't worry. Once you want to talk, I'll allow you. I'm the one muting you, ma. So using the historical pattern of dividend payments, the formula is what you've known, using the square root approach. That is the latest dividend divided by what? The base dividend into the square root of n minus 1. And you have the number of years as 6, as 5. Yes, 5. So the root of 5, 6158 divided by 2473 minus 1. When you do that, you have a growth rate of 20%. But using the Gordon's growth model, the Gordon's growth model is what? G equal to R multiplied by B, right? Where G is growth rate and R is rate of return, and B is what? Retention rate. Since the question is giving you capital employed, how do you get your rate of return? How do you get your rate of return? You can get your rate of return by saying that what? Earnings divided by capital employed multiplied by 100 over 1. Earnings divided by what? Capital employed multiplied by 100 over 1. What is your earnings? Your earnings in the question is what? The company's current dividend is what? 61. Your earnings in the question, current dividend is 6158, was paid recently out of the company's earnings of what? 62,858. So the earning is what? 62,858. The capital employed is what? 315,000 multiplied by 100 over 1. So your R will be what? Your R will be what? 20%. Let me show it here. Let me show this one. This one, I don't think anybody use this approach. So using Gordon's growth model, let me show this approach. The formula is what? G equal to what? R multiplied by what? R multiplied by B. You know the definition of each of these. G is growth rate. R is R is rate of return. And B is what? Retention rate. So how do you get your R? Let me show it. R will be equal to what? Your earnings.
EPS minus DPS over EPS.
Your earnings divided by capital employed. Your earnings divided by capital employed multiplied by 100. Multiplied by 100 over 1. So from the question, what is your earnings? Your earnings is what? 62,858 divided by what? Your capital employed is 315,000. When you multiply by 100, your R will be what? Your R will be what? Should be 20%. Please confirm.
Yes, sir, you are right.
Then for B, B is the retention rate. How do you get your retention rate? It is your earnings
minus dividend.
Earnings minus dividend divided by earnings. So what will that be? B will be equal to what? Your earnings is what? 62,858 minus what? 6,158 divided by what? 62,858. Everything multiplied by 100. So once you simplify this, what will you have? Your B will be what?
$90.
90%, same thing as 0.9. So with these two variables obtained, your R will be what? Or your G will be what?
R times B.
R times B, that is 0.2 multiplied by what?
0.09.
Multiplied by 0.9. And you have what?
0.18.
That is 18%. So you can now substitute these into your cost of equity formula. When you apply your dividend into the bracket of 1 plus G divided by SD share price plus G. So instead of the 20%, those that use the historical pattern derived, you're going to use what? 18% for growth rate. So what we mark is the steps. Somebody can come up with an argument that why is the result of historical pattern different from the golden growth model? Yes. There can be a critic. Yes, at postgraduate level, you criticize such things. That why is it? Are we having different results from using historical pattern and using the Gordon's growth model? It's based on the approach, based on the formula, based on the variables involved. That is where we are having the difference. But whichever approach you use, you will get your answer. As a matter of fact, the marking scheme will show the two approach, depending on the one you've used, you will mark as appropriate. So that is that, man. Hope this is clear, man.
Yes, sir. Very clear.
So next time, ma, if you have such concern, just reach out to me, ma. Yes, I will.
Okay, sir. Thank you, sir.
So let's take down the assignment. This assignment. Let's see. The Friday PLC has 11% irredeemable preference shares, irredeemable debenture rather, irredeemable debenture of 5 million naira, 5 million naira. In its capital structure. Its capital structure, which currently yield 8%. Currently yield 8%. Question is required determine the value of the company's debenture. Determine the value of the company's debenture. This is as simple as ABC. Let's take another one. This is 1. Question 2. Question 2. Edit PLC is financed with 8% redeemable debenture. 8% redeemable debenture. It's with the total nominal value. The total nominal value of 10 million. This debenture. This debenture will be redeemed in 10 years. In 10 years. In 10 years' time. At a premium. Redeem in 10 years' time at a premium of 5%. Now, if the debenture will be redeemed in 10 years' time at a premium of 5%, what will happen? The par value of debt is what?
100.
So if it is now at premium,
105%.
very good. So the current yield. So that I'm asking this so that you will not go to your book and start thinking, but you didn't talk about, we explained issue of par, premium, discounts. No student can come and say, but he didn't solve it now. He solved the simple one and he's giving us the hard one. The current yield of the debenture is 7%. Required. See the statement. So calculate the unit value of the debenture. Calculate the unit value of the debenture. Unit value of the debenture. Let's take another one. Question 3. Let's pass. The more you solve, the more you win.
We never do PN zone.
No problem. Now you do it now.
We have lecture tomorrow again.
Even me too, I'm not resting now. Not easy to teach now. I taught yesterday, teaching now. Tomorrow I'll teach. Tuesday I'll teach. I have other many things to attend to. The way you are feeling it means I'm feeling it.
God will see us. We have mercy on us this time.
The only difference between me and you is that I'm not under pressure of exams.
Yes.
So that is just the difference. But I'm also not. It's good to rest now. It's good to just be sleeping. So, but sometimes, if you're a person of purpose, it's not good to sleep. So, Badmoss PLC has 10% redeemable debenture. In its capital structure. The debenture is currently quoted. Please learn to solve questions yourself. Don't go and copy it and paste in ChatGPT. I don't need it. If you don't understand, say you don't understand. Don't go and copy and paste. Because when you go to the hall, you don't have ChatGPT to paste on. That is what some students used to do. So be sincere to yourself and try to analyze questions by yourself. That is what will help you in the exam hall. Because you have AI tools now, you just go and do copy and paste. Required. Calculate the cost. The cost of the company's debenture. So that is that. Those are the assignments. I'll forward the slide to tonight's class to the platform. So I'll forward the timetable too. The days we'll be meeting to the platform. Likewise, I will just try and do that tonight. I think for FM, I think Friday and Sundays, because on Thursdays I also have my lectures. I have a lecture, I have a class. I need to learn to under someone. So I have a class too, a graduate class. So then I think Friday, Sunday for FM. Please let's take note. Friday, Sunday for FM. Then for PM, Tuesday, Saturdays. That is right to go.